They told you gold moved on fear. That's not a lie. It's a shortcut. Because the real story isn't the headline. It's the hidden mechanics. On January 2nd, gold sat around $4,332 an ounce. By January 29th, trading economics showed about $5,507, roughly a 27% surge in under a month. Reuters documented the climb. Gold broke $5,000 for the first time on January 27th, then punched above $5,200 the next day. And on January 29th, Reuters reported a fresh intraday record at $5,594. And then the rally snapped. The air pocket opened. Your 1-hour chart printed a single candle down roughly 7 tutos, and your daily Oanda feed showed gold printing 4,709. From Reuters' record high to a 4,700 print, that's roughly a 16% air pocket. Reuters called it the steepest one-day drop since 1983. This wasn't mysterious. This was structure. This was what happens when momentum finally meets liquidity, and liquidity wins. Now listen, because January 30th is where the story got sharper. Reuters reported gold fell more than 8% and briefly broke below $5,000 as the dollar firmed ahead of President Donald Trump's expected Fed chair decision. By 11:32 GMT, Reuters reported spot gold down 5% at $5,124 after sliding to $4,957 earlier in the session. Same metal, same month, different lever. Start with the one the headlines almost never explain properly. Real yields. Gold doesn't just trade emotion, gold trades opportunity cost. And the cleanest real-time proxy is the 10-year TIPS real yield. On Fred, the 10-year TIPS real yield was 1.95% on January 22nd and 1.90% on January 27th. Real yields were still positive during this run. So this wasn't rates didn't matter. This was demand and positioning strong enough to overpower gravity until expectations changed. Next lever is the dollar. Gold is priced in dollars, so the greenback isn't background noise. It's the lens the entire world buys through. Reuters tied the surge, especially the push through 5,200, to a dollar drop toward a near 4-year low. And Reuters tied the January 30th hit to a firmer dollar tied to Fed chair speculation. Here's the rule. When the dollar loses altitude, gold doesn't need perfect news. It just needs a catalyst. When the dollar firms and the market reprices the Fed's future path, gold doesn't need a scandal to drop. Which brings us to the Fed. Because the Fed isn't a meeting, it's a signal. On January 28th, the Federal Reserve maintained the target range for the federal funds rate at 3.5 to 3.75%. And the statement showed two dissenters who preferred a quarter-point cut. So the headline said, Fed holds, but the pros read the dissent. Now zoom out, because there's a bid under gold that doesn't trend on TikTok. The World Gold Council reported central banks bought over 1,000 tons in each of the last 3 years. And Reuters, citing the World Gold Council, reported global gold demand hit a record in 2025, with investment demand up 84% to a record 2,175 tons. That's not retail FOMO, that's structural demand. So here's the truth. The gold is up because fear headline never gives you. This market is a machine, and that machine runs on 4 dials: real yields, the dollar, the Fed path, especially the signal hidden inside dissents, and structural demand. That's market literacy. Because the ticker is the outcome, but the levers are the cause. So next time gold rips or collapses in one brutal candle, don't ask, what headline did this? Ask, which lever moved?